Have you ever wondered why some of the strongest stock returns happen on Mondays, and why high-quality companies consistently outperform the market, yet no one seems to talk about it? In this video, I'm going to reveal a hidden edge that combines two powerful ideas from quantitative finance: the quality minus junk, QMJ, factor and the mysterious Monday premium in US equities. We'll explore what the QMJ factor really is, how it was discovered, and why it's been quietly outperforming for decades. More importantly, I'll show you how traders and quants are using this factor to build smarter portfolios, and even time short-term trades with surprising accuracy, especially at the start of the trading week. I'll also walk you through real-world tools like Python, Quant Connect, and Alpaca to help you build and test your own QMJ-based strategies. Whether you're a retail trader or an intermediate quant, stick around. This episode is packed with practical insights, strategy tips, and a few surprising behavioral finance truths that could give you a serious edge in the markets. Let's dive into the data and decode how quality and timing can work together to boost your trading results. When I first came across the quality minus junk, QMJ, factor, I was struck by its simplicity and effectiveness. Go long high-quality stocks and short low-quality, or junk, stocks. This idea, introduced by Asnes, Frazzini and Peterson, 2013, at AQR, builds on the notion that quality firms, profitable, growing, well-managed and financially safe companies, tend to earn higher risk-adjusted returns over time. In practice, a QMJ strategy ranks equities on multiple quality metrics and then overweight the top tier while underweighting, or shorting, the bottom tier. Remarkably, AQR's research found this long-short QMJ strategy has earned significant historical risk-adjusted returns in the US and 24 other countries. In fact, they documented that quality stocks command higher prices on average than stagnant or poorly managed firms. Yet the price premium is surprisingly small, implying high-quality stocks have delivered persistently strong returns over long periods. QMJ is thus part of the broader factor investing toolkit. In the 1990s and 2000s, academics and practitioners explored factors like value, size, momentum, and low volatility. The quality factor in general was often measured via profitability or earning stability. In Fama and French's 5-factor model, 2015, for example, the profitability factor is one slice of quality. But Asnes et al. Defined QMJ as a composite quality measure, combining profitability, growth, safety, and payout metrics. This multi-dimensional approach reflects different aspects of what makes a company high quality. For instance, Alpha Architect's Larry Swedroe notes that high-quality firms typically have low earnings volatility, high margins, profitability, high asset turnover, low financial leverage, and low specific stock risk. These traits, also echoed in the QMJ definition, explain why quality stocks may shine especially during market stress. In the years following Asnes et al., many studies have confirmed QMJ's prowess. The Alpha Architect blog and Fama French Factor Analytics also treat quality as an important style. Importantly, QMJ is not confined to US equities. Researchers have replicated it globally. In fact, a key recent insight is that the QMJ factor exhibits a pronounced Monday premium around the world. This day-of-week effect means that quality stocks tend to outperform on Mondays, with junk stocks lagging by a large margin. Chia and Zhang, 2019, showed that QMJ generates a positive, negative premium on Monday. Friday. The QMJ premium on Monday is 2.89 times higher than its daily average. They interpret this in behavioral terms. Investors get optimistic, elevated mood on Fridays, favoring speculative junk stocks then, but return to a more cautious outlook by Monday. So quality stocks enjoy a relative boost as the week begins. This Monday effect appears in 24 international equity markets, suggesting a pervasive weekday pattern in how the quality effect materializes. Drawing from this research, I see at least two practical angles for traders: short-term timing and long-term portfolio building. On the short-term side, the QMJ Monday Premium suggests a weekly rotation strategy. For example, one could run an algorithm that forms or adjusts a long-short quality portfolio weekly. Buy, or overweight, the quality basket on Friday close, then enjoy Monday's outperformance before selling those gains later in the week. One might even day trade within Monday to capture the open-to-close move, though intraday data would be needed. The logic is to ride the historically strong QMJ return on Monday. Of course, this requires careful execution, for instance, placing orders before weekend news or using limit orders to manage overnight risk. With crypto trading running 24/7, there is no weekend gap per se, but one might still see different volatility regimes on weekends versus weekdays. For FX, trading days include weekends in some cases, but markets like Forex are largely continuous. Thus the Monday boost is mainly a stock market phenomenon. For longer-term investors, QMJ can be a styled tilting tool. A multi-factor portfolio might include quality, QMJ, along with value, momentum, low volatility, etc., to diversify sources of alpha. Many quantitative funds and ETF providers already do this. For instance, Dimensional Fund Advisors and Bridgeway use profitability, a subset of quality, in their multi-factor funds, which implicitly builds QMJ exposure. A long-only approach is also possible. Buying a basket of high-quality stocks, often large caps with steady earnings, can be thought of as a partial expression of QMJ. Academics point out that quality stocks have tended to weather recessions well. Swedroe even notes they deliver especially strong returns in down markets. Meanwhile, an outright long-short QMJ hedge fund could profit from arbitrage if fundamentals diverge from prices. Indeed, AQR's Global Factor Library allows backtesting exactly these portfolios. They provide hypothetical decile portfolios and the long-short factor returns. The key is that quality signals tend to have low correlation with, say, simple value, book to market, or with raw momentum, so adding QMJ can change the risk profile in useful ways. From a data standpoint, constructing QMJ requires fundamental or accounting data. In practice, I often use a combination of profitability ratios, ROA, gross margins, accruals, growth metrics, earnings growth over 5 years, and safety measures, leverage, earnings volatility, beta. For example, Asness et al. Measured quality by factors like gross profits, margins, cash flows, 5-year growth of those, and inverse market beta, effectively weighting each by firm size. In Python, one can fetch this data from sources like Yahoo Finance, via libraries such as yFinance or pandas_datareader, or from institutional feeds, Bloomberg, FactSet, if available. Open databases such as Kenneth French's or AQR's datasets, AQR shares their factor returns and sorted portfolio returns free online, can be used for preliminary analysis. For a retail quant, free APIs like Alpha Vantage or the SEX Edgar can provide financial statement line items to build our own quality scores. When coding a QMJ strategy, tools like Pandas and NumPy are invaluable. I typically create a data frame of stocks with columns for each quality metric, normalize or rank them, e.g. converting to z-scores or percentiles, and take a weighted sum to form a single quality score per stock. Then I sort or threshold these scores, for instance, go long the top 10% and short the bottom 10%. This can be backtested with a simple loop, rebalancing monthly or weekly, or using a library like Backtrader or Zipline. For more systematic analysis, quant libraries like AlphaLens, by Quantopian, allow you to compute factor return profiles and information coefficients given your computed scores. In practice, I might use Backtrader or backtesting.py for strategy simulation. Another popular cloud platform is QuantConnect. It supports Python and has fundamental data via Morningstar integration, though note historically it was limited to technical data, requiring workarounds for fundamentals. You can also load custom CSVs, e.g., from Quandl, into such engines. The key is to avoid look-ahead bias. Update fundamental data only after reporting dates, and align price returns accordingly. When exploiting the Monday effect specifically, we schedule trades around the weekly cycle. One approach is to rebalance portfolios on Friday market close and then close out or trim positions on Monday afternoon. Alternatively, keep positions through Monday and rebalance on the following Friday. Either way, one should compare the actual outperformance of Mondays in backtests. As Chia and Zhang found, Monday QMJ returns triple the factor's average daily return, a huge anomaly if it persists. However, be mindful of risks. Holding positions through a weekend means exposure to overnight news. If using margin or leverage for shorts, the financing cost over weekends must be considered. Another risk is that this pattern could weaken if many traders try the same tactic. In fact, some quants suspect that once a factor is well known, its premium shrinks, as happened with low volatility strategies. On the other hand, longer-term QMJ investing has its own pitfalls. Quality stocks often carry higher valuations. By design, investors pay up for quality, so QMJ may underperform during speculative booms. For example, during the tech bubble of 2000, high-quality .com firms were richly priced and eventually crashed, whereas some lower-quality stocks, like busted tech companies, fell even more. After the bubble, QMJ recovered strongly, illustrating AQR's finding that when quality becomes cheap, low price relative to fundamentals, future QMJ returns surge. In other words, the price of quality is time-varying. At extremes it reverses. This means one should monitor how expensive the QMJ factor looks, e.g. its current alpha versus CAPM, before betting heavily on it. Another controversy is why QMJ works. The original AQR paper admitted this is a puzzle. They cannot tie the returns of quality to risk, nor show that prices fully reflect quality, suggesting that QMJ's premium might be an anomaly or require a new risk explanation. In simple terms, either quality stocks have hidden risk, not captured by classic models, or markets systematically undervalue quality. Some behavioral theories propose that investors irrationally overpay for lottery ticket, junk stocks when sentiment is high, which hurts their returns. Indeed, the day-of-week findings support a sentiment angle. Nevertheless, from a trading perspective, I treat QMJ pragmatically. It has worked historically and adds diversification, but I build risk controls, stop losses, position limits, in case market dynamics change. Extending QMJ beyond equities is challenging. In crypto, the concept of quality is fuzzy. Coins lack cash flows or accounting. Researchers and quant bloggers have suggested proxies. For example, higher quality crypto assets might be those with large developer communities, real-world usage, or sustainable tokenomics, whereas junk tokens could be speculative meme coins or illiquid coins. One blog proposes using on-chain signals as analogs to fundamentals. Metrics like in, out-of-the-money holders, or exchange flows, to gauge profitability and momentum in a crypto asset. In practice, some traders look at fundamentals like active GitHub commits or network transaction volume as quality indicators. If I were coding this, I might rank coins by their developer activity or on-chain transaction growth as a quality measure, and short very thinly traded junk coins, though shorting is harder in crypto. It's very experimental, and factors like liquidity and news tend to dominate crypto returns. But in principle, an analogous QMJ thesis can be explored, always remembering that crypto often has extreme volatility and 24/7 trading, so Monday versus Friday patterns may not be relevant. In Forex, a QMJ type approach is not common. Currencies don't have corporate profits, so one can't literally do quality minus junk. However, you might loosely interpret quality as a strong, stable economy currency, like the Swiss franc or Singapore dollar, and junk as currencies of fragile economies. Yet most FX quant strategies focus on carry, interest rate differentials, and momentum. If I were creative, I could construct a quality score for countries, say based on debt, GDP growth, inflation, and go long high-quality currencies and short riskier ones. But one must be careful. Interest rates, carry, might overwhelm such a signal. In any case, I would treat QMJ in FX as an academic exercise. It's more straightforward to apply QMJ in equity markets where the data and precedent exist. Thank you for watching, and I look forward to the second part.